Good morning and welcome. I would like to begin by thanking all of you for participating in this meeting. As all of you have been informed, this meeting will start by reviewing the past two financial crises, the Great Depression and the global financial crisis in 2008, and start formulating strategies on what we can do to avoid the turmoil from happening again. Could you tell us some background information about the Great Depression, particularly what had happened and that were of concern? Mr. Ho, please.
Of course, the Great Depression started from an ordinary recession in the summer of 1929. Consumption and investment were dropping, yet the stock was doing well, and it reached its peak in the early October. However, stock prices eventually went down and the stock market crashed on October 29, which is known as the Black Tuesday. Panic selling resulted in an estimated loss of wealth of 30 billion. The Great Depression was triggered by this panic selling. People lost confidence about the future economic condition. Consumption and investment fell in response. The situation was worsened in the autumn of 1930 with the start of the first wave of banking crisis. Large amounts of investor demand to withdraw their deposits at the same time. Banks had to call back a loan to meet the obligations. Some banks closed up as they were not able to repay deposits. This resulted in credit contraction. There was even less liquidation in the economy. Consumption and investment decreased subsequently, so the profits earned by companies and wages of workers. The economy suffered from a vicious cycle of deflation and high unemployment. The situation was relieved after President Franklin took the office and the subsequent implementation of a series of expansionary fiscal and monetary policy. During that time, President Franklin abandoned the gold standard to enhance the effectibility of the US dollar money supply. Though the economy started to recover from the fall of 1933, a severe recession hit after the Federal Reserve announcement to raise the interest rate. The Great Depression was set to end soon after the breakout of the World War II, as the surge in military spending created a lot of job opportunity and healed the economy.
Thank you, Mr. Ho. That was a comprehensive description. Now, Mr. Mok, could you please tell us some possible causes and resulting consequences of the Great Depression?
Yes, there are a few causes we would like to suggest. First, the counter-cyclical monetary policy. The Federal Reserve raised the federal fund rate though the recession hit in August 1929 and did not increase the money supply during the early stage of the Great Depression. Second, speculation of investors and constraint from the gold standard. Investors sold dollars for gold in September 1931, which depleted the value of the dollar. The Fed raised interest rates to preserve the value of the dollar under the gold standard. The rise in interest rate increased the cost borrowing and further reduced consumption and investment. Third, the Fed did not take action to rescue falling banks. The vicious cycle of bank run and loss in confidence continued. Money supply was further decreased. Fourth, protectionism. Imposition of tariffs reduced international trade, which hurt the global economy and slowed down recovery. Fifth, bad banking structure. Low capital requirements for banks make it easy to start up new banks, and with the loose lending policy and the low margin requirements, there's no security on deposits. Also, the excessive investments in the stock market by banks with lack of risk management.
That's true.
As for the consequences, during the Great Depression, US GDP fell by 30%. Unemployment rate escalated by 25%. The industrial production dropped by 45%, and more than 50% drop in international trade. There are also serious bank runs, which caused thousands of banks to fail, including the Bank of America. And some even said it gave rise to the Nazi regime in Germany, which Hitler took advantage by using the hardship in Germany to grow his power.
Very well. Now, everyone should have a basic picture about the Great Depression, but we still need more information in order to formulate emergency fiscal and monetary plans for the potential financial crisis in the future. Particularly, What were the policies implemented to fight the Great Depression at that time?
President Franklin Roosevelt adopted more aggressive spending policy. Government spending increased from 3.2% of real GDP to 9.3% in 4 years. He also abandoned the gold standard to enhance the flexibility of USD money supply. He initiated the Federal Deposit Insurance Corporation to secure public deposit and initiated the Securities and Exchange Commission to regulate stock market.
Sorry for interrupting. Instead of the government action as mentioned by Mr. Mock, the Federal Reserve also took action to heal the economy. In particular, it increased the money supply and lowered the interest rate. It also provided loans to banks in trouble.
So now we have a thorough understanding about the Great Depression in 1929. Sure, we should go on and move to talk about the financial crisis in 2008.
The 2008 financial crisis is the most catastrophic crisis since the Great Depression, which happened in 1930s. The crisis was initiated in the US and gradually spread to other economies, such as the UK, Germany, France, Italy, and contributed to the collapse of Iceland and Greece banking system. There are various factors causing the outbreak of the financial crisis. Firstly, it is the under-regulated subprime lending. Since 2000, mortgage lenders relaxed the underwriting standards in order to attract and lend more to high-risk borrowers in a low-interest rate environment. With inadequate government regulations, borrowers with low capabilities were able to apply for subprime mortgages. Apart from that, the growing housing bubble also triggers the financial crisis. Mortgage originators and investors expect home price would continue to rise, although this belief was not supported by fundamentals.
Please proceed.
Between 2004 and 2006, federal fund rates increased steadily. At higher interest rates, borrowers could no longer afford their mortgages. Lenders foreclosed thousands of homes, putting downward pressure on demand. Home price started to collapse, the bubble finally burst.
Well, I like that idea.
The third factor causing the crisis is risk mismeasurement. The subprime mortgages were securitized into MBS and MBS CDOs. Cash flows of the tranches were unclear to investors and credit rating agencies. The credit rating agencies had little experience in evaluating such complex structured financial products, underestimated the risk, and overrated these products. This gave investors wrong signals who relied on the ratings to make investment decisions. Lastly, over-leveraging in the financial sector compounded the loss. Investment banks such as Lehman Brothers and hedge fund companies employed highly leveraged business models. Their assets were long-term and illiquid, while liabilities were largely short-term. Short-term liquidity and financing were therefore critical to the business. However, when investors shifted to safer investments, liquidity from the commercial paper market was virtually unavailable. Selling the investment below fair values magnified the losses due to leverage. Among all factors, agency cost is the most significant causes of the crisis. Lending decisions were influenced primarily by whether underlying mortgages could be pooled and resold, rather than whether the risks were acceptable to borrowers. The lending institutions repackaged their mortgages and transferred the risks to the whole market systemically. Please turn to page 15 of your meeting note. This table compares the consequences of the Great Depression in 1929 and financial crisis in 2008. We can see that the asset prices dropped and unemployment rose more significantly in the Great Depression. Therefore, the Great Depression had more severe consequences in terms of both extent and duration compared to the 2008 financial crisis. One of the reasons would be Ben Bernanke, the chairman of the US Federal Reserve, indicated that he would do whatever he can to avoid a repeat of the Great Depression.
Thank you. But are there any government responses from the US government?
Yes, let me introduce some policy responses to the financial crisis in 2008. There are federal deposit insurance. new debt issues, liquidity facilities, and travel asset relief program. For monetary policies, there are quantitative easing 1, 2, and 3 to reduce short-term interest rates. There are Operation Twist, which is aimed to reduce long-term interest rates by buying long-term treasuries and selling short-term treasuries. For fiscal policies, there are tax cut of $288 billion, spending of $410 billion on infrastructure, new energy, housing, and healthcare. There are social expenditure of $82 billion, which is aimed to extend unemployment benefits.
Thank you all for explaining the two crises in a precise and comprehensive way. Please let me summarize and compare them so as to formulate preparation work for the next crisis in an orderly manner. The first similarity that we can see from the two crises is that they are all caused by bubbles. For the Great Depression in 1929, it was caused by the bubble in the stock market, while the financial crisis was caused by the bubble in the housing market. However, the government responses of the two crises are very different. For the Great Depression, the government initiated the Federal Deposit Insurance Corporation to secure public deposits, and it also initiated the Securities and Exchange Commission so as to improve the financial market. For the financial crisis, the US government carried out quantitative easing and Operation Twist, and because some conventional monetary policy is no longer effective under the liquidity trap. For the Great Depression, some European countries cannot repay the loans due to the Great Depression because they do not have enough money for this. But for the financial crisis in 2008, it indirectly causes the European debt crisis. For the GDP figures, the Great Depression, during the Great Depression, the GDP dropped for about 28%, and it took about 10 years to recover. However, for the financial crisis, it dropped for only 9%, and according to some microeconomic indicators, it shows that the economy has started to recover since 2010. Facing uncertainties in the global economy and stages of recovery are different among countries in face of the incoherence in pace of recoveries and global economies, and the over-reliance on monetary policies to fight recessions. It is expected that the global economy would face a number of unprecedented challenges ahead, and stricter regulations on the financial markets and banking sectors are substantial.